It's time for a market update. Swatch barely broke even in 2025. LVMH struggled. Richemont struggled. Basically, the entire Swiss watch industry has had a rough few years. But Citizen, they grew. Seiko grew. Both completely outpaced their Swiss competitors. And that's strange because we've been told for years that affordable watches are dying, that everybody just wants an Apple Watch, that the future belongs entirely to luxury. But the numbers just don't really support that. Actually, I think the Swiss watch industry may have accidentally created some of its own problems and not the ones we think. It's also ended up creating a huge opportunity for a whole lot of other companies. Let's dive in. Swatch Group declined by 2.2% in 2025. Their operating result was halved to a net result of only 2.2%, and once taxes were paid, they made zero profit. Honestly, that's disastrous. Industries that don't deal in luxury goods are more profitable than a luxury watchmaker. Switzerland declined, Europe was flat, China declined, Asia in general declined. Only the US grew, and nothing else. Richemont have also released their most recent report. Their watch brands barely grew, and they declined at actual exchange rates because of the strength of the Swiss franc. They also barely eked out a 3.4% profit, which was more than a 50% decline in profits. Earlier in the year, LVMH largely demonstrated similar results. Based on the numbers of these three huge conglomerates, we can simply conclude that the Swiss watch industry is still in a very difficult place. But what's interesting is that it would be a mistake to conflate it with the state of the watch industry in general. Because at the exact same time, Seiko's watch division had a 13% operating profit versus Swatch's 0. They grew more than 15%. Seiko grew in all price points in the Americas. They grew in Europe for all segments except for Grand Seiko, where they were flat, and they also did well in India and the rest of Asia. Overall, their revenue is 203 billion Japanese yen. And Citizen, 10% revenue increase and over 8% in operating profit. That's double the profit of Richemont. Seiko and Citizen completely blew the Swiss watch industry out of the water in terms of raw numbers. Now, we've got this story that the watch industry is declining, but these data points are almost contradictory. And the reasons, well, a little bit complicated. The first thing you have to understand is that the world is not the same. There are four distinct global zones in play. The United States is a growth market almost regardless of the price point, with some key differences. Europe is flat for the mid to high end, China is down across the board, and the rest of the world is flat to down on high-end products, but growing in the low and low to mid-end. If you were to make assumptions about K-shaped economies based only on watches, then there would be no such thing as the K-shaped economy. Because all across the world, the low to low mid space of watches is growing, as demonstrated by Casio, Seiko, Citizen, and a whole lot of other smaller brands. In the ultra high end, all reports seem to indicate difficult times on average, but with individual brands performing very differently. And in that mid space that spans everything from Tudor to Rolex and JLC, you're seeing something that averages out to flat performance. A small group of brands continue to do really well, but a lot, if not most, are struggling. Success is being consolidated around a smaller set of brands. But in simple terms, cheaper watches are selling and are a growth market globally. The mid space is polarized and the upper space is still resilient but has challenges long term. And all of this is, at least partially, the industry's own creation. The first reason is that the Swiss have been aggressively exiting the affordable space for decades. They've been moving up market. Everybody and their sister have been raising prices and chasing more affluent customers. This has created space in the affordable space. Now you can see this mechanism in play with Tudor that have grown because of good products, but also because they've filled the space that has been left by Omega moving up market. This mechanism is just a whole lot more pronounced in the affordable space below $1,000. Under $1,000, you're not finding a long list of legacy Swiss brands dominating the space. Yeah, there's Tissot and to some extent Hamilton, but it's Citizen, it's Seiko, it's Casio, and a whole host of others, big, small, conglomerate-owned and independent, that are serving this segment. On a total level, there's very much a global and a US market for affordable watches. It's a market that's growing And the Swiss, as a group, have just relinquished that space to other companies. The second reason is almost a consequence of the first, the move upwards, because where they've left space in the low end, it's gotten more crowded in the mid and the high end. So generally speaking, most economies have some sort of pyramid shape. A lot of people have a little, some people have some, and a small group of people have a lot. The Swiss have all been moving up the pyramid. And yes, those people are more affluent, but there are just less of them. Take the mid-space. Breitling Top Time, sports watch on a bracelet, $6,100. IWC Pilot Mark 20, sports watch on a bracelet, $6,100. Panerai Radiomir, sports watch on a strap, $6,300. Omega Aquaterra, sports watch on a bracelet, $7,100. Rolex Oyster Perpetual, sports watch on a bracelet, $6,500. Go to any price point and you're going to find the longest list of brands that want to sell you a watch. And the higher in price you go, the more you have to remember that there are fewer and fewer customers. And very few of them are interested in owning more than one watch. It really is a case of massive industrial oversupply for a very limited demand. And it's not just because the space is crowded. It's also because these mid to high end brands have become perceived more and more as some version of bad value, where the low end is characterized by a hard push to convey value and affordability. Pretty much every other price point is trying to do the opposite. Breitling, IWC, Omega, even Tudor are barely leaning into any kind of message that they are good value offerings. Mid-range consumers, people with money to burn, are still critical. They don't have Mark Zuckerberg levels of cash, so they do make the calculation whether or not a particular watch feels reasonably priced. And I say feels because honestly, most people don't actually know how to gauge that. But ultimately, it's not important. If something feels expensive for what it is, then it is expensive for what it is. That there's still growth in the US is great, but the growth numbers by company are nowhere near what brands like Seiko and Citizen are demonstrating simply because there's so much more competition and so much more variety. Now, this doesn't mean that we'll see the Swiss pivoting back to the affordable space. The reality here is that anything produced in Switzerland, whether it's 40% Chinese or 100% Swiss, just can't be built at a cost that allows for the low-end price segment. Swiss salaries, Swiss utilities, and Swiss competencies are just too high in cost to deliver to this space consistently and also turn a profit at the same time. From the mid-space and up, there's also no strategic play when somebody's going to be lowering their prices. Margins are surprisingly thin for the manufacturers, and they don't have the room to go more affordable. Here, it's just a Thunderdome, last man standing kind of situation where it's a question of who has a product that allows them to take share from others in that very crowded space. The risk, as I see it, is also that the Swiss look at the external factors, and as a consequence of those, they don't adequately address the things that are within their control. So they look at China and they say, ooh, that's a problem. Can't do anything about that. Oh, can't do anything about the strong Swiss franc. Tariffs are also a problem. And then they sort of assume they don't have to do anything or can't do anything. But they can. And I think most, if not all brands, need to reconsider how they address the concept of value, because value is returning as a differentiator together with the typical emotional and status sales arguments. I'm not saying that Rolex or Omega should be a pure value play, but they need to have that element more prominent as a part of their signal. The growth in the low end signals that value is worth talking about, and it would be a mistake to assume that value doesn't apply to $5,000, $10,000, or $25,000 watches, because it does. The brands that don't have the cachet of Rolex, but do lean convincingly into some version or some element of value narrative, they just do better. This applies and is demonstrated by Tudor. This would apply to JLC, and it absolutely applies in the very high end. Patek Philippe can maybe charge whatever they want, but the number of other brands that can is exceedingly small. For MB&F, Vacheron, Lange, and a million others, they can still be ridiculously expensive, but perceived value, perceived quality needs to be a much bigger part of the storytelling. At this price point, though, you're not going to be calling it value, you'll be calling it craft, but it's the same thing. Communicating that your product is worth it on the merits of the product and not on the merits of the brand cachet. That's what I think is increasingly going to move product. Affluent, middle class, upper middle class, and rich people still think about how they spend their money, and brand alone is not enough. These customers are discerning, they are critical, they are well informed, and they're spoiled for choice. A couple might buy a watch because some famous person wore it, but more will buy it because it feels like a good use of their money, because it's perceived as a version of value for them. There's only a infinitely small group of brands that can get away with a purely emotional status play. It's brands like Rolex and Patek, but for many, for most, they probably can't pull it off. They probably need to lean more into value. The fact is, the world still wants watches, and the performance of Seiko and Citizen tell me that the world still wants cheap watches. Mid-priced watches also, and ridiculously priced watches. But the brands that win can learn from Citizen and Seiko. Make people feel that they're getting a reasonable deal. Then the customer's going to buy. Those were my thoughts. Share yours in the comments. Like, subscribe. Cheers.